Okay, in today's video, we're going to be discussing mathematical models again, loans, but in specific, we're going to be discussing credit cards and how interest rates are calculated on credit cards. But before we get into the discussion, here's a list of the assignments that are due for this upcoming week. We're in week 5. Again, we're going to be going over mathematical models. We're in module 3. So you'll have the Module 3 homework and the Module 3 quiz due by October 15th. To get to these assignments, as always, you go into Blackboard for this class, Module 3 assignments, and you'll see the 2 assignments listed at the top. So as I mentioned, we're going to be talking about loans, and specifically, we'll start with an introduction about loans. A loan is pretty much a thing that is borrowed, especially things like money that's expected to be paid back with interest. And as we discussed in our last video, interest is pretty much the amount of money that you have to pay in addition to the amount of money that you borrowed. So interest is money on top of the principal or the original amount that you borrowed. An installment loan is a loan that is paid back with equal regular payments. It's amortized, and we'll talk about how to amortize loans and how that affects the payments. There are 2 different types of loans that we're going to discuss today. We're going to discuss the open-ended loan or the revolving loan and the fixed installment loan. The open-ended loan or the revolving loan is a loan in which variable payments are made each month. So one month your payment can be $100, the next month it could be $200, the following month it could be $50, but there's not a fixed amount that you pay. It's just variable. Now, the fixed installment loan is a loan in which the amount is paid off in a set number of months. So it's more of a fixed amount. It's generally paid off within 24 months or 2 years. 36 months is 3 years. 48 months is 4 years. 60 months is 5 years. Those type of loans are more like college loans, car loans, and also like mortgages. The revolving installment loan is more of the credit card, which we're going to discuss a little bit more in depth. Okay, so the Truth in Lending Act of 1969, it required that lending institutions tell the borrowers 2 specific things. One, they need to know what the APR is, or the annual percentage rate, which is the true rate of interest charged for a loan. And then they also had to disclose the total finance charges, which is the total amount of money that the borrower must pay for borrowing the money. So this is interest plus any additional fees that's charged for the loan. So as you can see in this example I have, let me make it a little bit bigger. You can see this is the top of Truth in Lending disclosure statement. So you see you have the borrower's name, you have their address, the date of the loan or the origination date, and then these are the 2 things. You see the 2 things in the bold black boxes. Those are the 2 things that you have to see any loan that you receive. You have to know what the APR is, and you also need to know what the finance charge. So they'll also put the amount that's financed and then the total payments, which is the principal plus all of the other fees plus the interest, all of that wrapped up in the total payments. So these 2 boxes, the annual percentage rate and the finance charge, those have to be listed on any type of loan, whether it's credit card or whether it's mortgage, car note, you have to know what the APR is and you have to know what the finance charge is. So a credit card is a popular way of making purchases or borrowing money. Credit cards differ from fixed installment loans in that you are not required to pay off your balance in any set period of time. So again, the fixed installment loans, those are the ones that you usually have a set time period of when the loan's going to be paid off. Credit cards on the other end are those revolving installment loans where you don't have a set time that you have to pay it off and you don't have a fixed amount that you pay off. It's variable. So as you can see, this chart displays the average credit card debt in America based on net worth. And when we talk about net worth, we're talking about our assets minus our liabilities. So your assets are things that make you money. So that could be things like a business, stocks, any type of investment that's actually making you money. That's your assets. Cash, that's your assets. Your liabilities are things that are taking money away from you. So things like insurance, some home mortgages, if you're not making any money off the home, that's a liability. So you have to understand that what net worth is, what an asset is, and what a liability is. But this chart tells you, or it shows you, what the average credit card debt is in America. So based off of the net worth percentile, you see 25 percentile, their average credit card debt or their credit card debt is usually or around $4,830. When you get to the 25 to 49.9% percentile, the average credit card debt is $5,230. When you get right in the middle with the 50% to 74.9%, that's that average that we talk about, the $6,270 of credit card debt. And then as you go up with the percentile of the net worth, you see as you continue to increase your net worth, that credit card balance increases as well. So a couple of things to note about the United States and how we deal with consumer debt. So the U.S. consumer debt as of July 2021, the U.S. consumer debt is $4.2 trillion dollars. And inside that consumer debt, you have credit card debt. 45.4% of families carry some sort of credit card debt. So almost half of Americans have some form of credit card debt. So what we have here is a typical monthly credit card statement. So some things that are typically listed on the credit card statement are things like the balance at the beginning of the month. So the new balance, the balance at the beginning of, or the balance at the end of the statement period, or the new balance. That's what that is. You have the transactions with the amount. So the new purchases, you see $1,957.24. You have the statement closing date. So here's the statement period. So April 1st to 30th. And then you have your payment due date, which is the minimum payment is due. And the thing with the minimum payment, they say you can pay this small amount by a certain date so you don't get charged a late fee. But the less that you pay on the balance means the more that you're going to pay in interest. And you see right here, it lists the interest. So as of right now, no interest was paid, but there's a fee that was paid. So maybe this is a new card, but, or no, it's not a new card. So it looks like this person, or this, for this example, this statement, that each month the person is paying off the balance, or they, at least they did it for the previous statement. So when you pay off the balance in full, you don't have to worry about paying interest. When you pay anything less than the full amount, that's when you start having to pay interest. And we're gonna do a couple examples on how interest is calculated and how those interest payments are calculated monthly, so you can get an idea of if your interest rate is this and your average daily balance is this, I can expect to pay this amount of money in interest on top of the amount that I borrowed using a credit card. So before we calculate the interest payments, we have to understand a few terms. We have to clarify it a little bit so you have an understanding of it. The first term is the grace period. The normal billing cycle for a credit card can range between 28 to 31 days. So in February, the normal billing cycle is 28 days. Months with 31 days, it's 31 days. The due date for the monthly payment is no less than 21 days after the end of the billing cycle. So each billing cycle provides you a grace period, which means that you don't incur interest on purchases made within that billing cycle if the bill is paid in full by the due date. So the outstanding balance is the accumulated amount that hasn't been paid. So if you're not paying the bill off full by the due date, you're going to have to start worrying about an accumulating amount. The second term is to understand the simple interest versus compound interest. And in the previous video, we talked about the difference between simple interest and compound interest, and we saw how if we started investing money early, how that money compounds over time and it grows and grows and keeps on growing. Well, with credit card companies and lending companies, that compound interest is also accumulating, where instead of you making money off of an investment, you're actually paying money, and the money that you're borrowing and paying off, it's accumulating. That interest is accumulating over time. So we saw the good part of compound interest, but now we're going to look at the bad part of compound interest. So again, interest that you earn is a reward. Interest that you have to pay is a penalty. It's not good. So we're going to look at how credit card companies calculate how much interest they charge you every month. And again, that interest is added on to the amount of the balance. So whatever you borrow or whatever you charge using your credit card, if you don't pay that bill off in full by the due date, you're going to have to start accumulating interest over and over again. And remember that compound interest, it's the eighth wonder of the world, and it's a good thing when you're making money, but when you have to pay that money back, not so good. So let's talk about the three steps in calculating credit card interest. So the first step is you divide your APR by 360, or some companies use 365 to find out the daily periodic rate. Again, we talked about simple versus compound interest. Step two, you calculate the daily, you calculate the average daily balance. Step three, you multiply the days of the month times your daily periodic rate times your average daily balance. So we have three examples that we're going to go over. Um, we're going to say that the balance that we have there is the average daily balance. But that's not how it's calculated in the real world. It's based off of whatever your average daily balance is. So whatever you charge per month, they divide it, and that's what your average daily balance is. So, but for the sake of this example, we're going to use $3,500 as a daily average, the average daily balance, and then we're going to use $1,000 as the average daily balance, and then we're going to use $4,500 as the average daily balance. All right, so for our first question, what would the interest amount be if your balance is $3,500 and your interest rate is 25%? So step one, the first thing we need to do is find out what the daily periodic rate is. So the daily periodic rate is equal to whatever the interest rate is. So 25% divided by, we're going to use 360. So I'm going to let me put equals here, and then we're going to do 25% divided by, hold on, there we go, 25%. What is going on? All right, I know 25% is 0.25, so I don't know why it's acting funny. Divided by 360, that gives me that, but I need to multiply it by 100 to get a percent. So that's our percent. So our percent is 0.0694%. So that's what our DPR is. So the next thing we need to do, and we already know this, we already know what the average daily balance is. We know the average daily balance is $3,500. And after we have that, we need to multiply the average daily balance times the days in the month. So we're going to use September. So that was 30 days in the month. And I'll put 30 days here. And then times the 0.0694%. So if we put that in there, times 30 times $3,500. So our interest payment is going to be $72.92. So again, we went step by step. First, we had to calculate the daily periodic rate, which we took the interest rate that we had was 25%, divided it by 360. Second thing we had to do was calculate the average daily balance, but we already said that we were going to use the balance that we had in our problem. And then the third thing we did was we multiplied the average daily balance times the daily periodic rate times the days of the month in September, which is 30. And all of those numbers gave us $72.92. Okay, so the next question we have, B, what would the interest amount be if your balance is $1,000 and your interest rate is 35%? So again, we're going to go step by step. Step one, we divide the APR, or the interest rate, which is 35%. And we're going to divide that. We're going to use 360 again. And that's going to give us, let's see if the calculator works this time, 35%. Nope. So 0.35 divided by 360 times 100, because we want to get the percentage. So it is 0.0972%. So 0.0972%. And we know our daily balance we're going to use for this is $1,000. So we're going to multiply that times $1,000. And then instead of using 30 for September, we're going to use 31 because we're in October right now. So we're going to multiply that times 31. Oh, that's not right. Hold on. What did we do wrong? So 0.35 divided by 360 equals times 100. All right. Oh, percent. That has to be percent. Then we multiply that times 1,000 and then times 31. So our interest payment for if our average daily balance was $1,000 and our interest rate was 35, our interest payments are going to be $30.13. All right, so we're going to move on to the next question or the next problem. And let me erase that top part. Get rid of that. I need a little bit more space over there. I'm running out of room, so daily rate equals. All right, so we have 5% divided by, we're going to use 360 again, and we're going to calculate our daily periodic rate. So if we do, we know that 5% is equal to 0.05 divided by 360, but we have to multiply by 100 because we want to get the percentage. So 100, so it is 0.0139%. So that's what our daily periodic rate is. We know that our daily balance, based off of what's in our example, is $4,500. So we need to make that a percent, and then we need to multiply that times 4,500 times 31 days for October, and that gives our payment is going to be $19.38. So if our balance was $4,500 and our interest rate was 5%, we would expect to pay $19.38 in interest. That's our discussion for loans, credit cards in specific. That's the discussion for today. If you have any questions, feel free to reach out to me by emailing me or including something in the comment section, or you can text me if you have my phone number. So if you don't have any questions, feel free to like this video, and I'll talk to you on the next video.